So now we're going to look at a net present value question with irrelevant costing included. And this is a question where there's a series of pieces of information available in relation to a firm. You'll find the full question online. So we have a number of figures, therefore, that we're going to build across on this. So we have a number of years that we're going to deal with. We're going to have sales, we're going to have cost per unit, we're going to have a couple of other things as well. So in this question, the sales start off at 750,000, but they go up in each year by 15%. So what we do in year 2 is add 15% onto 75,000. Year 3, add 15% onto 86,250, and so on, all the way through. Then, on top of that, in terms of the number of units that we sell, we start off with 200 units, and in this case, we're adding 10% on each year. So 200 in the first year, 220 in the next year, and so on. So when we multiply the selling price per unit by the total number of units in this case, we end up with a total sales figure for each year. And that sales figure, as you can see, is quite high. It's in the millions, so starts at 15 million and goes up to 38 million, which means therefore we can work out what the total sales are in this case. So if that's asked as part of a question, clearly you can do that. So the next step is to calculate the variable costs in this case. And so we have a series of costs here that again are provided. So the per unit variable cost is €15,000. And in this question, you're told it goes up by 6% per year. So again, it goes up to 15,900 in the second year, and add 6% onto the 15,900, and you go all the way through to year 5. So once you have that, again, we know from previously what the number of units were. We know they go up each year, so we'd already calculated that, which means, again, in this example, we can calculate what the variable costs are in each case. And so there's a number of different costs involved in here, and once we work out what each of those variable costs are, then we're in a position to work out the total variable costs in this case. And the total variable costs in this case equal to €20,877,572. So now that we've all of that done, we can work out what the overall cash flow is for this project. And so in this case, we have a number of years starting with year 0, and we go all the way through to year 5 in this case. So let's start with the sales in this case. And year 1 is 15 million, and we calculated each year's all the way up to year 5, and so we're just going to slot those figures in here. Once we have each of those, we then are going to subtract the variable costs, and so in this case, the variable costs start at 3 million. So we take the figures that we've already calculated and we add them in here in each case in this example. So once we've had all the variable costs added in, we can then take out the fixed costs, which were given in the question, which in this case was 2 million each year. So for each of these, we're just going to do a straight subtraction. So each one of those goes in for each year at a negative 2 million euro. And as you can see, I managed to slip in a typo there at the end. So I have 20 million instead of 2 million. But the calculations are still going to be correct in this case. So once we have all of this information worked out, we can then in this case do a tax. The question tells you that it's 25%. So if we've worked out what our taxable income in this case is, we can just multiply that taxable income by the tax rate, and that gives us the tax charge for each year. So the cash that we'll actually get in from sales, less all the cost of sales, after tax, are the figures that result from this calculation. So you can see so far we've been calculating net cash flows for each year from year 1 to year 5. So now we've projected that the cash outflow for the asset originally is going to be 25 million euro, and that there's going to have to be an additional investment in working capital of 5 million. In addition, there's an avoidable amount of research and development. There's actually a higher amount of research and development in the question, but only a portion of that is actually avoidable and is therefore relevant in this case. And so we have other costs then that occur at different stages. So we have additional working capital. We have other costs that go out at different times. We also have the working capital coming back at the end and we also have site reclamation costs. And so by the time we calculate all of those out, we have a series of cash flows that are in and cash flows that are out. In this question, the discount rate provided was 15%, so we use that 15% to get the discount factor from the tables. We then multiply that discount factor by the cash flow for each year, which discounts it back to the value it's worth to us if we were to receive that cash flow today. And if we add up all the individual cash flows and subtract the 30 million as the original investment, we find that we actually make a loss in this case of €2,302,000. In that scenario, the decision criteria is very simple. If it's a negative cash flow, if it's more cash out than in, then we don't do the project. So in this case, we would just reject this project.